makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. European gas prices jump after workers at key Chevron sites in Australia begin long-awaited strikes in a dispute that's roiled global energy markets. Apple continues to weigh on the Nasdaq, the tech giant losing nearly $200 billion since Beijing decided to curb iPhone use. Well, we'll bring you the pre-market moves in just a moment. Plus, Goldman Sachs reported to be moving to fire underperformers as soon as next month. Now let's take a look at the European market map. A lot of the focus, of course, on dollar, the biggest story this week. The dollar snapping some of its winning streak. Stock markets rebounding from some of the recent losses. Traders really focusing on dovish comments that we had from Federal Reserve officials. If you look at the FTSE, gaining 0.1%. The DAX also a little bit higher to 0.1% higher. But it all has to do with LNG. This is really the big story today. So if you look at natural gas, and we'll get onto that in just a second. So energy markets this morning really taking center stage. Workers at Chevron's sites in Australia started long-awaited strikes. This is year to date. And you can see it's still down a touch year to date, although today at the open we saw a 10% increase. And then we look at NASDAQ. It was one of our top stories, the NASDAQ 100 closing, of course, below the 50-day moving average. I think we have that chart. If we don't have that chart, we'll bring it to you very shortly. This all has to do with price to perfection for some of the tech stocks. Apple shares, in fact, dropped almost 3% yesterday, with its two-day slide actually wiping around $190 billion from its market value. This is amid concern about iPhone sales in China. So let's get straight to Bloomberg's Alex Webb with the very latest. So Alex, first of all, how important is the China market to Apple's bottom line?
It is Apple's second biggest market after the US. It's about 20% of total sales, so it clearly is significant. I think we need to put, nonetheless, these bans in a little bit of context. What has happened is that, according to Bloomberg sources, China is cracking down on the use of iPhones in state-owned enterprises. So that's not just clearly government ministries, but companies such as PetroChina that are state-controlled. There's some estimates out there from analysts that represents, actually a very small percentage of Apple's total sales in China. The bigger issue, therefore, is whether it speaks to the mood music. Is there a rise in sort of Chinese nationalism where just ordinary people are more inclined to buy Chinese-made products rather than those from elsewhere? In the past, those sort of movements have chipped away at Apple's sales locally. That is perhaps what the bigger concern is right now.
The US says it's now investigating the made-in-China Huawei chip. What more do we know, Alex?
So Huawei has released this phone called the Huawei Mate 90 Pro, and it's like it uses a chip made on the sub-7 or on the 7-nanometer process, which is very, 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 very small and very close to actually what Apple is able to do through its contract manufacturer TSMC. It isn't, nonetheless, the bleeding edge. It is about one generation, depending on what Apple announces next week with its new iPhone, maybe 2 generations behind. It is nonetheless a lot better than what everyone had expected. The US is now carrying out an investigation to see how they've done this and, crucially, whether any sanctions have been broken in the course of its manufacture.
Alex, thank you so much. Alex Webb there with all of our terrific roundup, of course, some of the tech news that we saw overnight. Now, global gas prices jumping on the news that LNG workers at key Chevron sites in Australia have begun partial strikes today after talks failed to reach an agreement. Now, for more on all of this, we're joined by Bloomberg's Will Kennedy. Now, Will, thank you for joining us. We knew that this wasn't going well, but actually it's incredible. There are 2 facilities in Australia, and if you look at the 2022 numbers, they accounted for 7% of global LNG.
So this could become a big deal for the gas market. I think it's worth bearing in mind that it will happen gradually. They start some sort of go slow measures over the weekend. And then on the 14th, that's when they walk out entirely, and it would probably stop the production of LNG. So it will take a little while to seep into the market. But as you say, there's a lot of gas at stake in a global market, which is still fairly tight after the war in Ukraine.
Well, I think a lot of people were surprised. We were expecting this, and we knew that they hadn't found an agreement with, of course, the trade unions. And yet, at the open, the price of LNG, went up by 11%. What does that mean?
It's come back a little bit now. I think that's probably reaction to the fact that the rhetoric from the union in Australia is extremely strong, and the noises that we're hearing for them is that they don't see a landing zone for a deal at this point that aren't expected, and it's becoming clear and perhaps clearer that there won't be substantial negotiations over the next few days. So I suspect that the market is adjusting to the fact that it's now accepting that this strike is likely to happen and may have an impact.
So how long could this last? And I don't know, is it impossible to model like every extra week the strike goes on? How much does it impact?
Well, at the moment,
price?
I think the full walkout starts on September the 14th and then lasts for 2 weeks. But clearly, if there's no deal, then there's more industrial action in the offing, and we get closer to that time when demand will rise in the Northern Hemisphere in the winter months. Now, stockpiles are fairly full in Europe right now, but we are vulnerable to a cold weather over the winter, cold weather in Northern Europe. And so as we get into the autumn, and if we're denied the 7% of global supply, I think it will change the equation for many gas traders.
The strike, I mean, Chevron wouldn't do that. Or they, I mean, I know we don't know, but it just seems like a big gamble for the world economy. And once, if there is an agreement, can they just switch it back on like this?
Well, they can switch it back on, but with these big plants, it always takes time to get things up and running. There'll be lots of safety checks that they have to do, and the schedule they have of loadings will be knocked out of kilter. So it will have an impact, but they can presumably work to get things back on strike. I think what you say is true. Clearly, Chevron has an enormous incentive to have a deal. Woodside, which was the other company involved in these talks in Australia, did reach a deal with unions, which is why I think the market might be a little surprised that things have broken down in the case of Chevron. It will presumably get resolved sooner or later. It's just a question of how soon or how late.
Yeah, well, thank you so much, Will Kennedy there, our Senior Executive Editor for All Global Commodities. Coming up, we hear from New York Fed Chief John Williams on where U.S. monetary policy is ahead of the Fed's September meeting. That's next, and this is Bloomberg.
To keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again to make sure that we're keeping that steady progress in terms of getting imbalances, shrink imbalances in the labor market and bring inflation back down?
Well, that was New York Fed President John Williams speaking exclusively to Bloomberg about the Fed's rate path ahead. Now, with an eye to the Fed's rate path and wider markets, we're also joined by BlackRock Senior Investment Strategist Laura Cooper. Laura, how many times do you look at dollar a day? It's like dollar, it's up, oh no, it's down. What does it mean for the rest of the world? I mean, is this going to be the big driver?
I think certainly the dollar upside that we have seen more recently has surprised our expectations. We question the sustainability of that. Largely as we look forward to the Fed, we do think that the Fed is probably going to signal a hawkish pause, because if we look at some of the indicators that have come through in terms of labor market tightness is easing, we are seeing signs of moderating job growth. So some of those tailwinds for the dollar are likely going to fade as we head into the back end of the year.
I don't know how you communicate a hawkish pause, because once you pause, does the market just assume you're done and even maybe bring forward some of the cuts priced in?
And I think that's the key risk that the Fed wants to avoid. They want to keep the optionality open. They want to suggest that they're going to continue to remain data dependent because they don't want those easing expectations to be pulled forward. If we look for what's priced in 2024, it's already quite aggressive for just over 4 rate cuts, I believe. And so that's starting about May or June of next year, which does suggest 1 cut at every meeting nearly, which does appear too aggressive, especially when we think about this is an environment where inflation still remains above that 4% range. They're going to keep rates in that restrictive territory until they see meaningful signs of that disinflationary trend becoming entrenched.
So what does that mean for what you're buying right now? I don't know if it's T-bills or anything longer ended.
I think if we look at the U.S. rates complex, certainly we have seen that back up in the 10-year Treasury yields, really testing those cycle highs once again. And the key question is, okay, is now the time to really buy that dip? Not yet. And I think that's largely because the inflation outlook does remain quite uncertain. And we do think that investors are going to demand that higher compensation in this elevated inflation regime. And particularly if we look at the front end of the curve, we do think that there's still attractive attractive income opportunity there provides a little bit more support, because even if the Fed does pause, you're going to get some of that capital appreciation. But our view is that we're going to see those elevated yields around that 5% mark for quite some time. So why take the duration risk?
Makes sense. Talk to me about Europe. So Europe, actually, we're seeing a deteriorating economic backdrop, but at the same time, and we have LNG today that will directly impact, of course, Europe. So it complicates matters for the ECB.
I think certainly the growth backdrop does complicate the matters for the ECB. Notably, if we look at those leading indicators in PMI gauges, it does suggest that we are going to see Europe in contraction by the end of the year. And especially if we look at the recent release of Q2 GDP revisions, does suggest a very weak handoff to Q3. At the same time, inflation does remain elevated. We do have that headline measure about 5.3%, and it is tracking in Q3 above the ECB's forecast for about that 4.7% mark. So it does suggest that the ECB will take the opportunity to hike its policy rate next week. We think it certainly is a loose conviction call for us, but I think there's less certainty from them that they're going to have that optionality to hike later in the year when that deterioration in growth becomes more pronounced.
But Laura, overall, I know this is a bit maybe philosophical, but is there a real danger of over-tightening at this point? Is this maybe we talk about 25 basis points here or there, and maybe traders are largely ignoring the huge impact? I mean, could this be the one that tips the balance?
I think that is really the key risk, and it's something that we just heard from comments from the Fed speaker, in the sense that they want to ensure, is this actually sufficiently restrictive? Where is those neutral rates? And it's really hard to determine in this environment. But that being said, they've really focused on that realized inflation rather than those indications of forward inflation expectations, which does suggest that they're going to take the opportunity to hike now rather than the risk that they are still behind and they have to hike later on. I think interestingly, if we look at inflation expectations in Europe, as evidenced by those five-year forward swaps, the fact that they have risen, they're about that 2.5, 2.6% mark. Right. Isabel Schnabel more recently did suggest that that's a bit concerning, because it does suggest that markets are losing confidence that policymakers can bring inflation back to 2% targets. So they want to get ahead of that. They want to keep those inflation expectations closer to where their target is.
Laura, what does it mean for European government bonds? And also shout out to Dan Curtis on our team that got me that exact chart earlier this week.
So I think one area where we are seeing more comfort because of the growth dynamics is taking on long duration exposures in European government bonds, in particular core. And that's a high conviction view over what we are seeing in U.S. Treasuries, because the growth backdrop in the U.S. does remain fairly resilient. So as we start to see more of that deterioration come through in European data, we are taking more comfort in taking those exposures in longer end rates, but as well as some of that high quality credit exposures as well.
Okay, then we have the UK, where you believe that signs of household stress are yet to come. And then we have this incredible story that we'll also cover extensively at the end of the show. I mean, to rent a room in London, a room, not a house, not a little flat, is more than £1,000 a month. I mean, what does it mean for the consumer?
As somebody who lives in London, I can't say I'm that surprised by that indicator, but I think certainly it does reflect Governor Bailey's comments that we had earlier this week, where he did suggest that they are near the end of their hiking cycle, largely because we've seen this marked decline in inflation. He does expect that to persist, but he did acknowledge that the lagged and variable policy, monetary policy, will take some time to feed through, and we have yet to see the full impact of that. So in our view, it does suggest the BOE is going to hike one or two more times and then pause to assess the effect of that cumulative tightening to date. That's largely in the price. And that's why we are taking more exposure in gilts, for example, at the longer end of the curve, because we think a lot of that is already being reflected.
Because people thought actually it was worst case scenario for the UK, and it looks a little bit better, I guess.
It does look better. In terms of what we've seen from recent GDP data, has been revised higher. We are seeing growing signs that labor market is showing some signs of softness, which does bring some reprieve to the Bank of England members, but I think it's just too soon at this point to clearly see that that's going to have a very negative impact. So far, they want to continue to hike to keep inflation expectations anchored.
Okay, Laura, this is the Cooper big number of the day. So we every day we find a big number, and today we actually looked at this, and we kind of had to take a double take. So Apple's two-day slide has sapped $190 billion on the valuations of Apple. I mean, this is pretty incredible. And this is as China plans to expand a ban on the use of iPhones to government-backed agencies and state companies. When you look at tech, I mean, this is incredible. It's understandable given the noise we're hearing from China like 3 days before.
Yes.
Also, they have to release a new iPhone. But all of this trade war or noise, what does it mean for not only tech, but the rest of some of the U.S. equities?
Well, I think given the fact that we have seen this, quite relentless run up in tech so far this year, yes, we've seen that come under pressure more recently. It doesn't necessarily suggest that we've seen an inflection point where the defensively tilted tech sector will continue to come under pressure, largely because if we think from the past earnings season, this is showing signs of sustainable profitability. We look at those earlier cost efficiencies that were put in place earlier this year. We do think that's going to spill over into bottom lines. So ultimately, this is still going to be a sector that's going to continue to meet those still elevated earnings expectations. If we look for tech, EPS estimates for the next 12 months or so are above 14%. If we think that's probably the only sector where the demand dynamics are sufficient enough for them to actually be able to meet those market expectations, we have less conviction if we think elsewhere in the sector complex.
Laura, as always, thank you so much for joining us. BlackRock Senior Investment Strategist there, Laura Cooper, touching, of course, on gilts, T-bills to Apple. Coming up, underperformers at Goldman Sachs could be shown the door as soon as next month. That's according to the FT. More on that report just ahead. This is Bloomberg. Now, U.S. lawmakers say China's top chip maker, SMIC, warrants investigation as the company appears to have violated U.S. sanctions by supplying components to Huawei. Now, tech insights in the company, which Bloomberg News worked with to break down Huawei's new Mate 60 Pro smartphone and uncovered the technology inside. Oh, we spoke to their vice chair, Dan Hutchinson, earlier.
The big significance is it shows that China's been able to get around or at least, get forward on some of the sanctions that were on them that limited their access to 7 nanometer equipment technology and beyond 5 nanometer, 3 nanometer. So the result of it is that they've been able to clearly get from the 14 nanometer to the next generation, which is 7 nanometer. And it's a pretty clean looking device in terms of when we got in and we looked at the devices. So it shows that there was a really lot of excellent engineering on the part of the SMIC engineers to bring this part to market.
We had a previous guest who said you take a look at this and, does that kind of tell us that the whole tech Cold War has been pretty useless? Would you go so far as to say this is a breakthrough for China to the extent that the curbs from Washington have been ineffective?
No, not at all, because the rest of the world is at 3 nanometers going to 2 and the next year. So you go from 14 to 7 to 5 to 3 to 2, right? So they're still back 2 nodes, and the original objective of the sanctions was to keep China's fabrication capability 2 nodes back. And so there's still 2 nodes back. It's just that people had thought that based upon the equipment technology that was restricted there, that they would only be able to get, they wouldn't be able to get past 14 nanometer without a lot of yield loss. But the tool sets that they have is the same pretty much tool set that TSMC and Samsung used for 7 nanometer.
If you take a look at the progress since Tech Insights actually found last year at the Bitcoin mining machine, the 7 nanometer to now, has the pace of progress surprised you? And do you think you can extrapolate that to say what happens in the future?
I wouldn't say it was surprised. In fact, we'd pretty much predicted that this was going to happen, and it was just a question of when we would see it. We knew that the bit mining device was really crude and very poorly done. With access to more immersion deep UV tools, they would be able to get further down into the into the dimensions. They could get much cleaner patterns. And as they just simply, did the grind of the engineering, that sort of thing, it really brought them up to speed and was able to pull this device off. So that at least it can be done in volume, where the bit mining coin was not a really manufacturable device.
That was Dan Hutchison, Vice Chair at Tech Insights, speaking to Bloomberg. Now, Hong Kong's heaviest rainstorm since records began in 1884 is also flooding the financial hub's streets. I think we have pictures of that. It sent torrents of water rushing through subway stations, bringing much of the city to a standstill and forcing the stock market to scrap trading today. So, of course, we'll keep a very, very close eye on this. The downpour, which actually caught many residents off guard, comes just a week after super typhoon shut the city, causing government to issue its extreme conditions warning. Coming up, we'll bring you the latest on the G20 summit, including the news that President Biden is not planning to meet President Xi at Premier Li at the event. Now, European gas prices jumped after workers at key Chevron sites in Australia began long-awaited strikes in a dispute that's roiled global energy markets. Apple continues to weigh on the Nasdaq, the tech giant losing nearly $200 billion since Beijing decided to curb iPhone use. Plus, Goldman Sachs is reported to be moving to fire underperformers as soon as next month. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So we've had overnight news that from the U.S. that President Joe Biden does not intend to meet with the Chinese Premier Li Qiang at the G20 summit. Well, Bloomberg's Manaka Doshi joins us now from Delhi. Manaka, thank you for bringing us up to date with exactly what's going on the ground. What's on the agenda, and what are the implications, actually, of President Xi and Putin not coming?
Good afternoon, Francine. A variety of things on the agenda. I won't get to all of them, but critical for the G20 to find consensus and make progress on issues surrounding transition finance and climate change, the reform of multilateral development banks, and also the debt restructuring of lower income economies. Besides this, like you pointed out, unfortunately for India, which wanted a picture-perfect G20, it is going to be marred by the absence of the precedents of Russia and China, specifically China, given that no consensus on any of these critical issues can mean much without China's participation. So that will continue to be a regret for India when it comes to the G20. But it also creates space for India to assert its desire to lead the global south, given that China is not in the picture right now. It also creates space for the U.S. to be able to reach out to member countries of the global south and rebuild some of those fraying relationships. So that's what it's looking like right now this Friday afternoon in New Delhi before we kick off the actual summit over the weekend.
So, Manaka, now for the U.S., I guess, take on things. We heard from the U.S. Treasury Secretary Janet Yellen about this. So let's take a listen to what she had to say.
In spite of obvious problems due to Russia's war against Ukraine and Russia's, general absence from G20 initiatives, I believe the G20 has been extremely effective.
So, Manaka, what did you make of her comments?
Well, in a sense, Janet Yellen is pointing to the fact that there will be outcomes despite the absence. Earlier on in the week, President Biden had mentioned he was disappointed that China's Xi Jinping was not making it to the G20. Now, there are a couple of things to factor in here. I think how the Western nations will weigh in on the language used to describe the Russia-Ukraine war. That will be critical to whether we will have a communique or not at the end of Sunday. And if we don't have one, that'll be the first time in the history of G20 that we don't have a communique. What will replace it then will be a leader statement which will outline the areas of agreement or consensus. So that's one thing that we're watching out for. Besides that, we've seen the leaders of Western nations point to some of the differences with China on issues of, let's say, semiconductor technology. I think, the British leaders, Rishi Sunak mentioned that on his way to India. So we're waiting to see how the West will respond to the issues that China has raised, even though its leader is not here in the country, and also the wording of the communique?
Thank you so much, as always, Menaka Doshi, there from the G20. Now, Goldman Sachs is reported to be planning to dismiss underperforming workers as soon as next month. Now, the FT says the cuts are part of the Wall Street firm's annual staff evaluation. For more, we're joined by Bloomberg's Steve Ahrens. Steve, always great to have you on the program. Thank you so much for joining us. I mean, it was basically that there was a moratorium, right? That during COVID, Goldman tried not to fire too much staff. Are they just going back to what they used to do before?
Well, you're right. I think Goldman Sachs has been trying to get rid, really, of workforce that built up during really a hate time. I mean, remember 2021, but also 2022 was a time when investment banking was booming. It's been slowing down a lot, and so a lot of banks, but Goldman Sachs at the forefront, have been cutting down their workforce. This now seems to be really an annual exercise, and if it's actually really at the bottom sort of range of the annual exercise, then maybe it's just something regular.
So what does that mean, Steve, going forward? I mean, we talk so much about Goldman Sachs, and it's very rare that there has been, if not a revolt, certainly that the chief executive has had so much negative press. Does this change from within staff if bonuses go up?
Well, I mean, higher bonuses always make people happier, right? So everything else being equal, yes, people will be more happy. Will it be enough? I don't know. I mean, just right, the negative press Goldman has been experiencing has been really quite unique. I mean, I remember a time Goldman was so much in the press for the wrong reasons. And the CEO actually said yesterday he thinks that has been made a caricature. Clearly, it's taken a toll on him. Higher bonuses will be one way to address that. I don't think it would be enough.
So what comes next for Goldman?
I mean, it's a long slog, right? Once you're in the press like this, once a narrative, you need to get out of that situation. They need to show now consistently that they're on the right track, that they're not making any more strategic mistakes, such as a retail foray. And if that happens, then at some point, it will turn around and become a positive story again, but that will take a lot of effort. It's not going to happen overnight, and one set of good bonuses is not going to be enough.
All right, Stephen, thank you so much. Steve Ahrens there from our banking team, of course, on the very latest with Goldman Sachs. Now, the Canadian Prime Minister Justin Trudeau says there's no room for rapprochement with China, as President Xi Jinping's muscular foreign policy has made a normal relationship between the countries impossible for now. Well, Trudeau spoke exclusively to Bloomberg's Eric Schatzker in Singapore as part of a new Bloomberg New Economy series, Beyond Borders.
The way it's always been framed for our allies, whether it's in Europe or elsewhere, is the desire of access to markets, particularly the growing and engaged Chinese middle class that represents, a tremendous benefit for us. And over the past many years, there have been lots of friendly and sometimes less than friendly competition between allied countries. Whether it's Canada versus the U.S. versus Australia versus Europe can we get more beef in to China? We get more pork, and China's been very thoughtful about making sure that they just would play us off each other just a little bit in strategic ways that has been very effective. So for me, and certainly for the G7, as we've had conversations around this, the understanding that we cannot simply be trying to elbow each other out of the way for access to the Chinese market, but we need to be more thoughtful and concerted in how we move forward. Nuanced in our approaches is really the only way to go. I don't think the idea of crossing our arms and turning our backs on any part of the world is something that is good for the Canadian economy or Canadian people, but not being naive, being very deliberate about how we do it, and working in concert with our friends and allies is the right way to do it.
You mentioned the chill that settled onto the Canadian-Chinese relationship after the case of the two Michaels, as it's known. You've also made reference to interference in Canadian democracy. Is there political space in Canada for a rapprochement with China?
A rapprochement, no. Certainly not at this particular moment. China has made decisions over the past years that have made it more difficult, not just for Canada, but for other countries, to engage in ways, I will admit, in 2015, the conversations we had was about working on towards a free trade deal with China, working towards those sorts of things. But in real terms, the choices and the actions of China have made that more difficult. But like I said, we will continue to look for ways to engage constructively in ways of mutual benefit and try and rebuild a positive relationship in the interest of Canadians. But we're not going to be naive about it.
That was the Canadian Prime Minister Justin Trudeau saying there's no room for rapprochement with China. He was speaking to very own Eric Schatzker over in Singapore. Coming up, why employees want a workplace reset. We'll discuss the findings of Edelman's new trust barometer with its chief executive, Richard Edelman. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, with climate change among the key items on the G20 agenda, the spotlight is on the host nation's efforts to reduce carbon emissions. India is aiming to reach net zero by the middle of this century, even as it tries to meet the energy demands of its rapidly growing economy. Well, Bloomberg's Manaka Doshi takes a closer look at the challenges.
From electrifying public transport to solar rooftops to small urban solar parks like this one to the world's largest solar farm, biogas, hydrogen, India's throwing everything it's got at its energy problem. A problem of both demand and supply. An Indian consumes less than a third of the energy an American does on average. But there are 1.4 billion Indians, making it the world's third largest energy consumer. Rising incomes, industrialization and urbanization also mean rapidly rising energy demand, supplied mostly by hydrocarbons. Coal powers 70% of India's electricity. The country has the second largest reserve in the world. Petroleum products power transport. Over 80% of the crude oil is imported, posing a budget risk. Which is why India is aggressively pushing public and private investments across green energy, using a mix of local production incentives and import tariff barriers. The progress has been encouraging. By 2030, almost half of India's power generation capacity will be solar, wind, and hydro. Electric vehicle sales tripled last year, though they are a fraction of overall sales. And green hydrogen has drawn multi-billion-dollar bets from leading conglomerates. But there's still batteries, storage, grid transformation, so much to do. Last year, India spent $16 billion on green energy technologies. It needs at least 10 times that investment every year to 2030 to get on track with net zero. India needs to get this energy transition right. It would not be an exaggeration to say the future of the planet depends on it.
And we'll have full team coverage, of course, of the G20 in New Delhi, where we have Rishi Sunak just arriving for the summit. It was very clear over the last couple of days that President Biden of the U.S. now aims to seize this moment on the absence of two key adversaries for the G20, which is China and Russia. So the Russian President Vladimir Putin, the Chinese President Xi Jinping, both opted to skip this year's gathering, which means that Biden now has an opening to reestablish the U.S. as a pole star of this international system. So any Joe Biden, Rishi Sunak, of course, meeting will be crucial to that. I guess, President Biden will also want to do overtures towards Brazil, South Africa, and Indonesia, not to mention the host India. But it's always quite moving and quite telling to see how these world leaders interact. Of course, central to all world leader or every world leader effort to push is to try and figure out also the fund and scope of the World Bank and other development banks. And again, they're all probably going to try and deepen ties with some of the emerging economies and offer an alternative to China's state-backed lending. Again, Rishi Sunak and the UK could have a crucial role to play in this. We know that the US, for their part, plans to push for debt relief for poor countries, but also announce funding for new infrastructure projects. Biden, after that, will then visit Vietnam. It'll be interesting to see whether Rishi Sunak will spend a lot of efforts also going elsewhere in some of the emerging markets. Now, former FTX executive Ryan Salame has pleaded guilty to 2 criminal counts and has agreed to surrender more than $1.5 billion to authorities in connection with the dramatic collapse of the cryptocurrency exchange. Well, Bloomberg's Sue Keenan has more.
Former FTX exec Ryan Salem has now pled guilty to charges connected to the extensive fraud case against Sam Bankman-Fried. Salem joined FTX in 2019 and was a prolific political donor. He also bought a private jet and opened restaurants while the co-CEO of the now bankrupt crypto exchange's Bahamian subsidiary. As part of the plea arrangement, Salem pled guilty to 1 count of campaign finance violations. He says he made millions of political contributions with FTX funds at the direction of Bankman-Fried, and 1 count of illegal money transmitting. He was freed on $1 million bond, agreed to surrender more than $1.5 billion in assets, and did not promise to testify against Bankman-Fried, who was arrested in the Bahamas in December of last year and now faces trial in October. Notably, Bloomberg reporting shows that when the issue of potential fraud at FTX first came to light, it was Ryan Salem who had brought the case to the attention of Bahamian officials, reporting that customer funds may have been commingled. This latest plea arrangement clearly strengthens the prosecution's case against Bankman-Fried, who had his bail revoked by a judge due to evidence of witness tampering and is now awaiting trial while in jail. Bankman-Fried lost a bid earlier this week to get out of jail for a few hours a day to help his lawyers prepare for his case. That decision is now set to be reviewed by an appellate panel. Sue Keenan, Bloomberg, New York.
That was Sue, of course, with the very latest on FTX. Now, coming up, the cost of renting a room in London tops £1,000 a month for the first time. More on that next, and this is Bloomberg.
My first car was a Volkswagen Beetle.
The first car was a Volkswagen Beetle.
Today I'm in the very grateful position, being able to test a lot of cars.
It was a VW, it was an old Golf, one of the first examples.
My very first car was a VW Golf 1.
The VW Polo that I purchased, and that tells you how old I am, still for Deutsche Mark, not Euro.
A Corsa, very first generation, a Corsa A back in 1995.
My first Mercedes, and I think that's even more important, was a C-Class in the early 90s.
I didn't have my own car, so I was driving my mom's Oldsmobile.
It was a smaller car, and I developed myself
an F-150 pickup truck, manual stick shift in farming country.
When welding the unfortunately rusty floor, I actually set the rubber fuel pipeline on fire.
Was a Fiat Panda with an ugly, kind of blue, pale blue thing and beige interior. And then I had also a Renault 4, white Renault 4. That's why, it's something special for me to make it again.
Well, car makers and industry leaders are talking to Bloomberg at IAA Mobility at Munich about their first car. We also take submissions, of course, on social media. So please tell us your first car. we may tell you what our first car here is. Right now, it's all about electric as legacy companies scramble to catch up with Tesla and Chinese EV players. Now, Letting's website, Spare Room, says the average cost of renting a room in London has topped £1,000 a month for the first time. Joining us for more on the story is Bloomberg's Eamon Farah. Eamon, thank you so much, first of all, for a great story. I mean, it's shocking. £1,000. I mean, we all know if we rent in London that prices have gone up so much. But what exactly is driving this?
Yeah, so you said £1,000 is a huge number now. This is kind of for the average single room in a flat or a house in London.
For a room. This is the thing. Like, a lot of foreigners will be like, for a room?
Just a room. I mean, what's driving this? You've had this long-term kind of lack of housing stock in the UK, which means that, for a long time, it's been a bit of a struggle. But recently, with the rates that have gone up so sharply, mortgages are much more expensive. Lots of buy-to-let landlords are actually selling up and exiting that market, which means there's a bit of a lack of supply. And at the same time, people who maybe would have moved off of the renting, market, would have bought a house, they're staying renting for longer. So we just have more people in this market and just not enough properties. So you have about 6 people, every room available on the platform right now.
So what's the outlook for the London rental market right now? Does it just keep on rising? I mean, this is a huge cost. We're talking about cost of living crisis. This is it.
Yeah, I mean, this is exactly it. And the thing is, this kind of £1,000 actually holds back jobs, it holds back growth. People who would have been able to move to London and just start a job, start education, they are being held back and they aren't taking those opportunities. Where this is going, we are seeing a point where rates are maybe starting to peak. We are seeing the fact that mortgages in the next couple of years could come down. But the issue is, and what we're hearing is that if mortgages come down and there's savings for landlords or savings for investors, it doesn't always pass on to the renters, it doesn't always pass on to the youngest people. So it could be some kind of embedded inflation that stays for a lot longer.
Yeah, I mean, this is the thing, because actually wages may not, increase as rent does. Does it just mean that people will have to pay a bigger chunk of their salaries to rent?
Yeah, exactly. And in London, it's already a huge amount. I mean, £1,000, if you kind of have the average salary, it can be up to 40% of your salary going towards that. And that means that you cut back on other necessities. That means you've got to maybe move further away. And it causes so many issues, as I said, for the labour market. Labour shortages are rife in this capital. And that is also because accommodation is becoming so difficult, as we can see right now.
Is the government doing anything about it? Can they do anything about it?
I mean, the government is definitely, focusing a lot on the kind of more housing side of things instead of the more residential, purchases. The Bank of England on Wednesday were talking about how this is quite concerning, how the impact of rates on the rental market, but that, you have to kind of do this to drive down inflation. That's the most important thing right now for the country.
All right, thank you so much, of course, for all of your great reporting. That was Eamon Farah there with the very latest on, I mean, it's crazy, £1,000, folks, for one bedroom in London. We've never seen prices like that. Let's also have a look at what Apple has been doing. This is our big number. Thank you to Dan Tillis, TV Dan, for bringing us a big number every day. So this is our big number, and it's basically $190 billion have been wiped off Apple's valuation in 2 days because China is curbing or is putting some exceptions, of course, on iPhone. Apple, for the moment, pre-market, gaining some 0.2%. Of course, it's not a huge deal. We'll continue keeping an eye on Apple. But if you look at how much they've lost over the last couple of days and the fact that the timing of this probably couldn't be at a worse time because we also have the new iPhone being released in a couple of days. So Apple now looking to stave off a crisis in China. This is just days before the launch of its next iPhone, an already high-stakes event that will test whether new features can shake the smartphone industry out of doldrums. Up next, Bloomberg Surveillance, early edition. This is Bloomberg.